is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. The Adani rout continues, racing some $118 billion from the group's combined market cap. Shares of the flagship Adani Enterprises plunge 35% at one point, its biggest intraday drop ever. Underwhelming earnings from Apple, Alphabet and Amazon weigh on market sentiment. It's more evidence that an economic slowdown is throttling demand. Plus, the ECB says to expect another half-point hike next month, while the Bank of England warns that the UK has a long way to go in the fight against inflation. We'll bring you more from our interview with the Governor, Andrew Bailey. The picture for Eurozone, the data. So we are just getting some services PMI coming in 50.8. The preliminary figure was 50.7. It was interesting because we had just half an hour ago the French. That was a little bit worse than expected, and it indicated a contraction, whereas Germany actually came in better than expected, and it was also above 50. The picture for euro dollar is really not moving that much because the focus, of course, here is on the ECB and what Christine Lagarde said in terms of interest rate hikes. The market today, not only looking at central banks, because we did see initial rally after Jay Powell spoke on the Fed, and markets seem to be, taking that as a very dovish stance that we're reaching the near peak for interest rate hikes. The focus today is actually on earnings. So we had some disappointing earnings, not only from Ford and some of the automakers, which is why we're seeing so much pressure across the board when you look at the industry groups, but from technology companies, including Amazon, Alphabet and others. The picture here in Europe, so the FTSE really supported by some of the energy stocks. Yesterday, we also spoke to the Shell chief executive, which is why it's not dropping as much as, for example, a CAC 40, a DAX or a FTSE MIB in Italy. Shares of Adani Enterprises now are paring some losses after a steep drop. The group says it's in talks with creditors to repay some loans backed by pledged shares, as Asia's now second richest man seeks to restore confidence in his sprawling conglomerate's financial health. Meanwhile, global investors are dissecting their exposure to the Adani empire, which has wiped out half of the group's market cap value since the Heidelberg report. Well, joining us now, a Bloomberg opinion columnist, Kailey Leinz. Kailey, thank you for joining us once again. So what has happened to Adani so far? What's the latest?
So there are two different aspects of the Adani enterprise. On the stock side, pretty much, there will be some paring losses, but stocks is pretty much a one-way street going downhill. But on the bond side, it's more interesting in my view because there is a lot of investor-based jostling. So in the last couple of days, based on the prime brokerage reports that I saw, brokers are saying that real money has been selling their Adani bonds whenever there is any whenever there is any rally, and I think they refer to those investment-grade credit funds, whereas they also see that the hedge funds and distressed funds have been buying whenever there is a dip. So basically, you see that on the credit side, more cautious blue chip funds are leaving, whereas more speculative hedge funds are coming in, which makes sense because so far Adani bonds are traded are rated at the lowest tranche of investment grade, and it's pretty much going into high yield territory.
So, Kailey, is there a contagion risk? Is the Adani fallout shaking investor confidence in India more broadly?
I think there is. I mean, the problem with the Indian market is that it's quite expensive. It's no doubt a very fast-growing marketplace, but everything there is expensive. For instance, State Bank of India is trading at 1 times book. That's higher than, say, China Commerce Bank, Merchant Bank, which is arguably China's best retail bank. And then people are going to ask, we've been talking about Chinese banks' exposure to bad debt. How about the Indian banks? Perhaps could they have some exposure too? And in that case, do you deserve this 2 or 3 times book value valuation? So I think investors are going to have second thoughts with Indian stocks, especially since China has reopened and it's looking very, very cheap.
All right, Kailey, as always, thank you so much for all of your insights. Kailey Leinz, Bloomberg opinion columnist. Now, we're still seeing, of course, fallout from Adani investors, also digesting yesterday's big day of central bank action. The Bank of England hiked its benchmark lending rate for a 10th consecutive time to 4%. Governor Andrew Bailey explained the committee's decision.
Today we've increased bank rate by 0.5 percentage points to 4%. So obviously I want to start by explaining why we've done this. And I'm going to start with the outlook for inflation. Since the November monetary policy report, we've seen the first signs that inflation has turned the corner. Annual consumer price inflation has come down from 11.1% in October to 10.5% in December. That's below where we thought it would be in the November report.
With the Fed and Bank of England sending out signals of waning aggression this week, while after drastic tightening, the ECB's plan for the next big hike makes Lagarde the last hawk standing.
We intend to raise interest rates by another 50 basis points at our next monetary policy meeting in March, and we will then evaluate the subsequent path of our monetary policy. Our future policy rate decisions will continue to be data dependent and follow meeting by meetings approach.
To dig into all of this, we're joined by Sri Koshu-Govindan, Senior Research Economist at Aberdeen. Sri, thank you so much for joining us. Look, central banks, are the one thing that we need to focus on. And there was definitely so much hope in the markets that we would see a Fed pivot. Did the markets almost engineer it, or did they make the Fed sound more dovish than they actually wanted to sound?
I think that's a very good point in terms of how that communication actually came across. Yeah. It was very mixed messaging. So whereas officially they were still talking about the focus on inflation pressures and really talking about, despite the disinflationary pressures, that service sector and labour market's very tight. But it was really the Q&A where we saw some mixed messaging there. And it was the fact that there was less pushback this time. It was less aggressive when questions about financial conditions or, talking about the peak, there was less pushback there, and that was quite interesting. But I'd say that there were mixed messages, and I'd say that going forward, it'll be quite interesting to see the Fed speeches later this week. So if there is a miscommunication, we'll see that reverting quite soon.
So what do you see? Are they taking a pause also to understand the tightening that they've done so far, which we know lags, right, in terms of timeline?
Yes. I think there is a combination of that. Where that was what came across when discussing the financial conditions, which have eased and are easing further now in response to this speculation about a pivot. But we do think there's going to be another 25 basis points to go in the next meeting. But even then, we expect rates to remain quite elevated over the course of most of this year, even if there is a slowdown in activity and if there is a recession risk. So I think, yes, they do have a fine balance at the moment. We're close to the peak, and they do need to account for the fact that the monetary policy works with lags.
So is there, again, a worry that the market misunderstands, even if you're close to a peak, it doesn't necessarily mean that you start cutting?
Exactly.
And this is what the market is starting to price in. So are we going to see a readjustment in yield curves to really make sure that they understand what central banks are saying?
I think potentially, yes. I think markets are going to be adjusting according to communication and according to data. Really, the data we need to be following would be specifically the labour market data, not necessarily inflation indicators now, but really looking at the details within the service sector. Quit rates are still high across the service sector. So looking at the details there, we do think there's going to be easing, but primarily over the course of 2024. And I think that could be quite aggressive, actually, as we move into next year.
If you look at, specifically at the UK with a tight labour market, how difficult is it to go to that 2% inflation target?
Yes, we think it is. I think US and UK have that in common with the sense that you have that restriction in labour supply, and wage increases have been quite strong. And that was really coming across in Andrew Bailey's press conference yesterday. So we think it could be a much slower pace of disinflation is going to be quite strong from base effects, from commodities and from supply chains improving. But again, it's that labour market pressure and service sector. Core services are still quite elevated there. We do think there's going to be disinflation, but return to target, there is a risk that it could be slower than that's currently forecasted.
Do you think there are question marks over China's reopening and the effect that has on inflation, so imported inflation?
Exactly. So that's one of the key risks that we've been studying, actually, recently. So with the labour markets, that's the second key risk. We do think that China reopening is going to be very service sector led, and that will be an increase in domestic travel. We're already seeing that increase in the data, potentially some tourism. So that could be a boost for fuel demand. That would be the main area there. In terms of other areas of the economy, we'll wait and see, what happens with the infrastructure. Obviously, if there's a pickup in manufacturing, then that could be quite a big change for industrial metals. So that's something to watch. But I think the local government spending is going to be more focused on fiscal rather than boosting at the moment.
Sri, thank you so much for joining us. Sri Kochi Govindan, Senior Research Economist at Aberdeen, joining us on all the central banks this morning. Coming up, tech shares slide in late trade after Apple, Amazon and Alphabet report downbeat earnings. More of that story next, and this is Bloomberg.
As a result of a challenging environment, our revenue was down 5% year over year. We remain confident in and focused on the long-term opportunity.
As I address directly the North American stores questions, I think our, probably the number one priority that I spend time with the team on is reducing our cost to serve in our operations network.
The CEOs of Apple and Amazon, Tim Cook and Andy Jassy there, speaking after disappointing results for big tech this earnings season. Now, joining us now is Bloomberg's tech reporter, Aggie Cantrell. Aggie, good morning. So what's overall the big takeaway from these real lackluster results?
The overall takeaway from it is essentially what Tim Cook said, that Apple is not immune to the macroeconomic headwinds, be those inflation, coronavirus pandemic lag, or for instance, things like the war in Ukraine and the consumer sentiment drop. And so essentially what we're seeing across the board, not just from Apple, but Alphabet, Amazon, and other tech companies as well, is that these companies were buoyed during the pandemic, during the last downturn, where other companies were really rocked by a drop in consumer sentiment, but that consumer sentiment was driven to these companies. People were spending more time online, which drove digital ad spend, and also they were purchasing more tech as opposed to spending that money on experiences. And so now this shift is essentially these companies saying, we pushed forward during the pandemic, we made a huge amount of money, we had record gains, and now we're having to retrench and make sure that we're efficient so that we can be sustainable long term.
So, Aggie, should we have seen Apple's revenue drop coming?
I think that's a definite yes on the part of Apple, because essentially we've been seeing this coming for the company. We've seen the issues that they've had getting products out of China, with issues around China's continued COVID constraints, and also when it comes to their delays on launching new products. They are really reliant on these hardware sales, especially over the holiday period. And this year, without launching those products and delaying that, they essentially made sure that they were going to have lackluster sales over the holiday period.
So how is Alphabet and Amazon, how are they trying, Ag, to insulate themselves from headwinds going forward?
Alphabet and Amazon are two of the many, many tech companies that have announced huge job cuts. These are companies that had added many, many workers to their headcount during the pandemic, during those boom times, and now they're pulling back. And they're both communicating profitability as their main priority. As we heard from Andy Jassy in that clip you just played, their focus is always about costs and about keeping those costs under control and making sure how they're able to have a profitable business going forward. Also, a notable aspect on Alphabet's part is that they are so focused on needing to compete with the likes of Microsoft when it comes to AI. At the moment, Google has been focusing on AI, but very much still in the research phase. And I would expect that with the announcements of the relationship between Microsoft and OpenAI becoming so much deeper relationship, then the likes of Google are going to have to bring their own AI products forward onto the market.
Okay, Aggie, thank you so much, Aggie Cantrell. Looking sharp, I have to say, in like noir and rouge. It reminds me of the old Stendhal book, so we should read it and then twin some more, Aggie. I'm looking forward to that. Let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The Pentagon is tracking what it says is a Chinese surveillance balloon that lingered at high altitude over the western United States. A senior defense official says the balloon was first spotted earlier this week over Montana, home to American ballistic missile silos. President Joe Biden was advised against shooting it down because of the risk of falling debris. Now, the border between Hong Kong and mainland China will fully reopen next week for the first time in 3 years. China says it's cancelling pre-arrival PCR tests and the daily quota for travel across the border. However, a 48-hour pre-arrival test will still be required for visitors to Hong Kong who have been overseas within 7 days. Bloomberg has learned that hedge funds are now being targeted in a U.S. investigation into the use of WhatsApp and other messaging platforms for conducting business. Sources say the SEC has asked firms for evidence to determine if apps are being used to hide deals from compliance departments. It has already fined banks more than $1 billion for previous violations. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine, I missed the memo on a red jacket.
Almost, Leanne. We're so close. We'll twin on Monday. Coming up, the Bank of England signals the fastest pace of rate hikes in 3 decades, maybe drawing to a close our conversation with the Bank of England Governor Andrew Bailey. That's coming up next. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the Bank of England voted to raise interest rates by 50 basis points, lifting the UK's benchmark rate to 4%. Well, Governor Andrew Bailey spoke to me yesterday following that decision.
We don't have a view on the neutral rate which actually shapes our decision-making at the moment. And the reason for that, you might say that's an interesting thing for me to say, but the reason is that there is such uncertainty at the moment. In the landscape that we face. We've got very big moving parts. We've had very big shocks, and particularly very big shocks on the supply side.
But if you look at the market reaction, so you hiked by 50 basis points, and the market is taking this as a dovish message. Are they right?
Well, the market, of course, was expecting us to hike by 50 basis points. I don't think they will have been surprised by that. I think the market will also be focused on what we do next. And they will have seen some change in our language, and that's deliberate. I mean, that change is obviously deliberate. The way I would interpret it is to say we are going to react to the information and the evidence that we see. We haven't pre-announced an intention because we have reached a point. As I've said before, I think we have started to turn a corner. That's encouraging. There's a long way to go, and there are a lot of risks.
How soon do you think we'll see a cut from the Bank of England?
We're not in position of speculating on that at the moment. That's off somewhere in the future.
What? Not this year?
We're not speculating on when it is. I say in the future because rates do go up and down in the long run, but we have no date in our speculation.
Governor, we've heard a lot from the Bank of England about the many shocks that this economy is facing.
Yes.
What's the prescription to fix this longer term?
Well, I think there's a number of issues that come out of them, obviously. Some of those shocks are external and relate to, very sadly, obviously, the war in Ukraine, which is terrible. We are beginning now to see energy prices come down quite rapidly. Food commodity prices have sort of seemed to have reached at least a level, but it's not coming through yet in retail food prices. So obviously that's important. Europe has had a much better winter from the point of view of energy than I think people feared, so that's important. And then domestically, labour supply is the big issue, I think.
Does getting closer to the EU change that? Does it change the trajectory for the UK economy?
In the context of the EU?
In the context of Brexit?
Well, I think what we would identify is at least 3 big shocks that we can see. There's been COVID, there's been energy, and there has been Brexit. It's very hard to separate them out, but the judgment that we've sort of reached on a rather tentative, but I think the evidence is pointing that way, is that we identified that there would be a shock to UK productivity from the reduced openness of the economy. We thought that might emerge over a rather longer period. On our latest evidence, it's probably going to emerge over a rather shorter period and possibly by the end of the forecast's horizon, so look forward 2 to 3 years.
Our conversation with the Bank of England, Governor Andrew Bailey there. Now, we'll be covering all things UK every week on Thursdays at 9:30 a.m. in our half-an-hour special. Coming up, we look at, of course, not only government spending, but Sanofi, those shares sliding after forecasting slower profit growth on the back of vaccine weakness, while we speak to the Chief Financial Officer, Jean-Baptiste de Chatillon. That's coming up next, and this is Bloomberg. Well, the Adani rout continues, racing some $118 billion from the group's combined market cap. Shares of the flagship Adani Enterprises fall 35% at one point, its biggest intraday drop ever. Underwhelming earnings from Apple, Alphabet, and Amazon weigh on market sentiment. It's more evidence that an economic slowdown is throttling demand. Plus, the ECB says to expect another half-point hike next month, while the BOE warns the UK has a long way to go in the fight against inflation. We'll bring you more from our interview with Governor Andrew Bailey. So good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. Also, happy Friday. It's been quite a week between the central banks and the earnings. I'm Francine Lacqua here in London. So Sanofi shares lower this morning after the French drug maker forecast slower profit growth on the back of vaccine weakness and competition from generic medicines. Well, joining us now is the Sanofi Chief Financial Officer, Jean-Baptiste de Chatillon. Mr. de Chatillon, thank you for joining Bloomberg this morning. What are you most worried about in the next 12 months? Is it government spending, or is it just pick up in demand for some of the vaccines, but drugs in general?
Thank you very much for having me this morning. Well, really, I'm not really worried. You know, we've just delivered on 22 quite exciting results with 7% growth of the top line in 22, above 17% EPS growth, and we hit our target of 30% BOI operational margin in 22. So those results show that we are fully in accordance to our trajectories that we committed to in 19. And not much to worry about, especially as Sanofi has a very specific sweet point, is that 23 is the very last LOE, major LOE in our portfolio for many years to come. So we will enjoy steady growth in the years to come. Of course, 23 will be impacted by the Aubagio LOE, but behind the scene, it's clearly a very positive trend for the years to come of growth.
Okay, that's really interesting because we are seeing a bit of pressure on your share price, almost 4% lower on the back, of course, of the slowdown in profit growth. Talk to me about M&A. So we know that you've made some plays, but in the next 12 months, is there anything that you want to acquire in a specific part of your industry?
Yeah, well, M&A is a clear part of our capital allocation. You know, our first allocation is internal investment in science in our own pipeline. Then it's to invest in BD on M&A deals. And we just did in the last 2 years and a half, 25 of those deals to replenish and augment our pipeline. And we aim to go on doing this. Our priority investment TAs are well known around immunology, where we aim to be the leader in the coming years in immunology, but also rare and potentially oncology. So that's where we are really looking to go on investing, as we did in the previous years.
Can you give us an update on, for example, sales forecast for Dupixent? So this is your asthma and skin drug. I know some analysts expect it from 13 billion now to come to 18 billion by 2030. Is that the case, more or less?
Well, thank you for asking, because Dupixent is an incredible drug. And it's not just one indication, but it's multiple indications. And we are continuously adding new indication to this on the base of this product. Today, we are already the leading brand in respiratory in the US with Dupixent. And we are now mentioning that we will hit around 10 billion in 2023 with Dupixent. We also mentioned a waypoint of 13 billion without giving a precise year, but it's only a waypoint. And this waypoint doesn't include COPD. We are waiting for a readout for Dupixent in 23 about COPD, which could add a very significant upside to this forecast. So, yeah, this drug is just at the beginning of its growth.
Mr. de Chatillon, what's your relationship like with a lot of analysts or shareholders? So there is an underlying worry, I guess, that you're a little bit too reliant on Dupixent, but you also have some pretty incredible drugs. I'm thinking of Beyfortus, I'm thinking of Altuvio, so one is for hemophilia, the first one was for the respiratory virus. What do you think analysts are underappreciating at Sanofi right now?
Yeah, that's a very good point and a very good question, because I think those two launches we are going to execute in 23 are very important proof points. We are going with Beyfortus to bring to hospital patients, babies, and all infant protection for RSV. This is a first. This is a first in disease. This is an incredible possibility to really have a great impact for this RSV. You've just heard during this season, it was super impactful. It is the first cause for babies to go to hospital is RSV. So this launch will mark the beginning of a growth driver for Sanofi. On Altuvio, hemophilia A, is a game changer. Is really a game changer. Why? Because you can have a normal life for 4 days of your week with a weekly dosing, which is really a rupture, really a big improvement for hemophilia A patients.
So you believe these are game changers, but do you think investors are not appreciating that yet? Or do you think there's an unfairness in how they value and look at the company?
No, I would not talk about unfairness, and I think it's a journey. And we have to go on investing in our pipeline steadily to be able to bring more proof points. You know, Altuvio was nowhere just 3 years ago, didn't exist, and we developed it, and now we are bringing it to market. We need more of those proof points to gain the support and the momentum. You know, short-term trading is not significant. I'm really looking at the perennial growth of the company for the years to come, and we are absolutely determined to deliver on this growth.
Talk to me about some of the litigation surrounding Zantac. So, you know, shareholders frankly freaked out when this came out. Your share price, I think on the day, was down 10%. Do you think now you're over the worst? Have you paid like 80%, or are you expecting still more bad news on that?
Let's be clear. There was first, as you know, science doesn't support the plaintiff allegation. And there was a very important court judgment which was rendered with a Daubert case, which has really clarified things and confirmed that there was no link between this product on the allegation of the plaintiff. So since then, we do think that this Zantac shadow is going to diminish over time, and it's not really changing anything to our strategy nor to our execution. We are really looking ahead and looking to go on developing this growth. I just mentioned 2 launches, very important ones, 2 important readouts, COPD and tolebrutinib in 23. And we are, as we are now, with 27 readouts to come in the next 18 months. This is a great position to be in, and that's where we want to be, investing in science and bringing innovative drugs to patients.
Thank you so much for joining us, Jean-Baptiste de Chatillon, there, the Sanofi Chief Financial Officer. Now, we're also getting a bit of breaking news data out of the UK. We did have services PMI for the Eurozone as a whole. We had them for France and Germany individually as well. Now it's the turn of the UK. On the back of that, you can see cable 122.31. That January services PMI came in a touch better than expected, under 50, so we're still in a contraction territory, but coming in at 48.7, so close to 50 instead of 48. Coming up, we discuss the impacts of the Adani crisis to the broader Indian economy. Nandini Ramakrishnan from JP Morgan Asset Management joins us next, and this is Bloomberg.
fundamentals of our company are very strong. Our balance sheet is healthy and assets robust.
I think whatever blip is there on the stock market and whatever the, on the stock market is not going to affect the overall economy.
Investors will look through the short-term noise.
We can't comment on clients, as you know, but I wouldn't worry about it.
Once the current volatility phase settles down, India's sound macro fundamentals, because that's what I said, we are pursuing responsible growth and that will come through.
Once the market stabilizes, we will review our capital market strategy.
Well, our guests this week weighing in on Adani's record sell-off after the Indian group of companies was accused of fraud. Well, Adani has refuted the allegations. Staying with that story, an Adani Group says it's in talks with creditors to repay or prepay some loans backed by pledged shares, which Bloomberg has learned could happen as early as this week. Now, while global investors scrutinize their exposure to the Indian giant, Gautam Adani's decade-long ties with the Indian Prime Minister Narendra Modi have also come under the spotlight. While the billionaire's investment is heavily embedded in Modi's growth agenda, including multiple capital-intensive projects such as airports, power plants, and of course data centers. Now, we're now joined by Nandini Ramakrishnan, macro strategist for emerging markets and Asia-Pacific equities at JP Morgan Asset Management. Nandini, always great to speak to you.
Nice
Thank
to be
you so
back.
much for coming on. When you look at, first of all, valuations of a lot of the Indian companies, is there a global freakout, or certainly many questions about what Adani does to the Indian market as a whole?
So for the market as a whole, India has always been an expensive market, so it creates a bit of discussion on finding sort of those bottom-up opportunities. And actually, this recent episodes in the Indian market are a lesson in kind of that valuation discipline plus bottom-up insights. So knowing where you can pick the best companies that have those kind of rigorous balance sheets and qualities that you want to stick with. So I wouldn't say it changes our broader view on the asset class, and actually, might create some opportunities with the broader Indian market when you think about a stock selection process.
So is this something that could be systemic? I've heard parallels, rightly or wrongly, with Evergrande, and I don't know if there's any truth in that.
I wouldn't say we're concerned about the Indian market as a whole. We have a rigorous research process that looks at the financials, the exposures of other companies in India. So on the whole, I think we're still looking at India as one of the better long-term growth stories in emerging markets, and actually has some of the better, really great demographic potential, consumer potential. So I would say India is still one of our most interesting long-term stories in emerging markets.
So tactically, what do you buy in India?
In India, well, for now, I think it's looking at things like financials that have that sort of penetration growth story. You can also look at consumer companies that have that long-standing history in India that could grow based on the just really excellent demographic story there. So there's a few different sectors and options within the market.
Nadine, when you look at China and the reopening in China, because China is so much cheaper, does it automatically make you compare the two countries?
Yeah, definitely. If looking at EM across the countries, China is certainly one of the more attractive ones. You've got not only valuations on your side with China, but also the reopening story, which is not done, in our opinion. There's three phases we really think. The first is that kind of entertainment, travel, leisure, restaurants. But then you've got delayed purchases. Chinese consumers have saved a lot of money over the past 2 years. They're ready to spend it on furniture, autos, maybe even some home decor, white goods. And then you've got this third phase, which actually might stick around for a lot longer, which would be behavioral changes. So more online services, thinking about prepackaged foods that save you time and money. So there's quite a lot of stories still for the China reopening, we think.
How much inflationary is that for the rest of the world? Well, for China first and then for the rest of the world.
Well, luckily, China's the one place inflation is under all targets or sort of any risk right now. Of course, there's two issues. One is commodities. So increased movement and demand may cause commodity prices to rise, but we think there's still capacity globally to handle that without a huge inflationary spike across the world. But for China, we should expect a little bit of inflation after 2 years of not much consumption. There's going to be almost 8% consumption growth over the course of this year. That's going to come with some domestically produced inflation. And for now, that's fine. I think the PBOC will be watching that closely.
Nadine, overall, when you look at the Fed, of course, the dollar, which a lot of analysts are expecting to weaken, changes everything for emerging markets. Like, what did you learn from Jay Powell this week?
Yeah, well, this is one of actually the key factors for us in feeling like the stars are aligning for emerging markets. The dollar has come down massively from the October peak. And what that means is actually emerging markets, both from a sentiment point of view, but also when thinking about earnings coming into emerging markets, feeling stronger as an investor when you translate that return back. Should be an overall a very good year for emerging markets compared to last year, where the dynamics were totally different with the dollar and the Fed tightening.
But you're convinced that actually dollar can only weaken from here?
Well, the valuations are still a little bit more than expensive. We think 8% above fair value. So in that time, for this year, maybe there's a 2 or 3% depreciation. If there's something that's not in our base case, but let's say a really bad, worse recession in the U.S. than expected, or the Fed has to continue to raise rates after what we think might be a peak in the spring, then there is some strength for the dollar. But overall, we think the directionality is lower over this year.
So how do you play China?
Well, for China, it's looking at that reopening trades, which I discussed, the kind of phases of reopening. And
so sectors.
Thinking, in terms of sectors, obviously you have the local leisure, hotel, entertainment, some of the casino names we still think have room to run. And in terms of medium term, thinking about which specific parts of the kind of delayed purchases sectors will be. There's a range of them, whether it's dental treatments to, let's say, home furnishings that haven't been able to be purchased yet. So those are the kind of sectors that we are looking at in China, and as usual, having a bit of valuation discipline on those, because unfortunately there is still some price appreciation that's happened over the past few months, so you want to be careful about where you're picking.
Any other, I guess, plays where either stocks look cheap in other countries in that region?
Well, we look at Korea and Taiwan as well, where valuations are extremely supportive. So we think, thinking about the exposures in North Asia and Southeast Asia that are geared to China. So as an example, any Korean exporters will be set to gain. Thinking about also kind of more traditional kind of travel and tourism in Thailand, for example. So there are a few plays you can do within the region that make the emerging market space very interesting.
Nandini, thank you so much for joining us today. Nandini Ramakrishnan, they're macro strategist for emerging markets and Asia Pacific equities at JP Morgan Asset Management. Now, coming up, taking a victory lap, Cathie Wood's funds had a scorching start to the year, and she wants investors to know it. More from our conversation with the ARC chief. That's next, and this is Bloomberg.
For years, Russian refineries have been the EU's biggest fuel supplier, but no longer. New penalties plus existing curbs on crude could cost the Kremlin $280 million a day. And on top of that, Russia is significantly cutting gas exports to Europe. These are all funds that would otherwise help Vladimir Putin finance his war on Ukraine. Market watchers are concerned about price volatility. Europe will need to replace about 600,000 barrels a day of fuel imports. So who will step in to plug the gap? And will there be enough? Help could come from the Middle East, especially from countries bordering the Mediterranean. India and the US, both long-term exporters to the EU, have also stepped up shipments. And China could be boosting supplies as well. But for now, the markets are calm. Buyers in Asia could step in. But the real test will come once the latest restrictions kick in.
Well, that was Ollie Crook on the new EU and UK ban on Russian oil products, which of course comes into force this weekend. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Garrett. Hi, Leanne.
Hi, Francine. Bridgewater has named Karen Carneal-Tamble as its third co-chief investment officer. She's the first woman to hold the top investing job at the world's largest hedge fund. Bridgewater is bulking up its management less than 4 months after billionaire founder Ray Dalio stepped down as one of the co-CIOs. Now, self-exiled Hong Kong activist Nathan Law says he expects people who left the city for the UK to stay there long term. He says that will bring economic benefits for Britain. 2 years into the UK's visa programme, he told us he expects more Hong Kongers to leave the city.
We need support to preserve the things that we think that is going to counter China's narrative. For example, our preservation of our culture, our identity, our efficacy is crucial when it comes to whether we can have thriving and a strong Hong Kong overseas community.
Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thanks, Leanne. Cathie Wood's funds had a scorching start of the year, and she wants investors to know it. The ARK Investment Chief Executive Officer, who is known for making bold predictions, spoke to Bloomberg TV.
One thing that happened last year is we were able, with a number of papers, we called it our ground war. We were trying to help investors and advisors understand that if you take a look at truly disruptive innovation, which is all we do, and you look at other growth portfolios, large cap growth, growth generally, as well as the major benchmarks like the NASDAQ, you won't find much truly disruptive innovation in them. And so as we were getting hit so badly, what we also saw is investors taking tax losses in some of NASDAQ and other strategies and moving into our strategy, which was hit so hard because they did believe that we were going to rebound faster. We were hit the hardest. Our research would suggest that the $200 trillion that we expect by 2030 to be the market valuation placed on disruptive innovation, that hadn't changed. That hadn't changed. And so if you have a 5-year investment time horizon, yes, you move into our strategy. And oh, by the way, we are the new NASDAQ, which is one of the ways we were trying to convey, look, if you want to look at the future and truly disruptive innovation, the way the NASDAQ performed in the 80s and 90s, that's where we went for innovation. Okay, look through that now. You will not find the kind of disruptive innovation. It certainly doesn't dominate those indexes, maybe 25% of them.
ARK Investment Management Chief Executive Officer Cathie Wood speaking to Carol Massar. Now, this is the picture for the markets right now. We did start on a low on the back of some disappointing earnings in the U.S., the trio of Alphabet, Amazon, and others. U.S. 10-year yield 3.3940. Good job, everyone. You've made it to Friday. It's been a pretty hectic week in terms of central bank action. It started with Jay Powell, and this is on the back of earnings as well. So we'll look at, for example, cable 122.39. There's a bit of a debate on the market now. Do we have another 25 basis point hike from the Bank of England next month, and then that's it? Or is that it now? Euro dollar 109.27. Bloomberg Surveillance Early Edition continues in the next hour. This is Bloomberg.
There's been, in our view, a pretty significant paradigm shift from the kind of economic environment that we had for the last 40 years to where we're going this year and next and the decade ahead.
Concern around wage pressures, inflation becoming more entrenched, how central bankers talk about second-round effects. So I think it's a very difficult balancing act at this juncture.
I would not be surprised to see the Fed cut rates this year.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. The latest U.S. jobs report is out a few hours from now. The labour market may be cooling down, but will it be enough for the Fed? Tough times for big tech. Apple, Amazon and Alphabet post results that show the economic slowdown is hurting demand for some of their products. And a brutal sell-off gets worse. Gautam Adani's empire has now lost more than half its market value since that report from short seller Hindenburg Research. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, it's one of those weeks where you have absolutely no time to look back. Fed, Bank of England, ECB, all of those are done. Big tech, done to some degree. And now we look ahead to the jobs report.
It has been such a busy week, Anna, but of course, Asia had a lot of catching up to do overnight from what we saw in terms of those big 3 tech reports after the bell yesterday. So as a result, you did see tech shares under pressure in Asia as well. The Hang Seng Tech Index in Hong Kong, for example, one of the underperformers, down about 1.3%. And then there is other macro stories, of course, that Asian markets had to catch up to, including the central banks that Anna was mentioning. We saw a huge rally in the bond market off the back of the ECB and BOE yesterday, and Australia was playing catch up to that. The 10-year yield there down 16 basis points overnight to 338. But of course, the more micro story in Asia that we're watching, and specifically in India, continues to be Adani Group. It has been a wild trading day for the flagship Adani Enterprises. It was down as much as 35% intraday at the low point of the session. Then it was in positive territory by about 7%. Right now it's down about 2%, higher by 2%. Now it's literally changing in real time. A lot of big trades seem to be going on, but still, you cannot almost overstate the pressure that has been on this conglomerate. As Anna mentioned, Matt, over the course of just the last 6 trading days, really since that Hindenburg report came out, we've seen about half the market value of these companies wiped out.
All right, but interesting that it seems to be bouncing now and turning back around a little bit. We'll continue to follow that big story. Take a look at futures. We are down almost 1% on S&P futures, but yesterday in the cash trade, we gained 1.5%, 3.25% on the NASDAQ. So big rally yesterday caused by the perceived dovishness of Jerome Powell and the Federal Reserve, as well as other central banks, and the big beat by Meta, or really the cultural tone shift at Meta that it's going to be cutting costs. We have yet to factor in to the cash trade, obviously, what we see at the 3As, and we'll talk about Amazon, Alphabet, and Apple today. The U.S. 10-year yield coming up just a little bit, but still under 340 right now at 339.40, going out 5 significant digits. And NYMEX crude, although it's up, still with a 76 handle. So this looks like recession concerns are priced in. We had seen, remember, at the start of the week, more than $80 a barrel for West Texas Intermediate, and Brent was up there at 87, 88. Now we're looking at Brent, I think, around 81, 82. Anna's going to show that to you in just 1 second. We do see Bitcoin at 23,421, so it's holding over that $23,000 level, but off from the close over, well, there's no close, but off from midnight last night. Anna, what do you see in terms of the European markets?
Yeah, well, it's incredible, isn't it? The whirlwind we've been on in the last 24 hours or so. Matt, you're right to point to that story yesterday, the Meta story, and the perceived dovishness of central banks really lifting stocks around the world, including notably on the NASDAQ, but also here in Europe. Today is a different story. We factor in the negativity around big tech, the disappointment from those 3As, and we'll get more details on that story. And then later, we're going to look back to the macro story. We're going to look ahead to the jobs report. So there's so much going on, a bit of a tech wobble for some European markets, others being held up by some resilience in oil prices, we should say. Infineon then in focus for 2 reasons. Firstly, because of the fact they reported numbers. So the profits themselves coming in positively, better results than had been expected, actually guiding higher this business because of strengths in the auto sector. Although they do, this is a chip maker, of course, they do acknowledge that end consumer markets are looking pretty weak. But add into that the Apple story and the negativity around tech, and we see Infineon down 0.7%. Over in France, in the pharmaceutical space, this company, Sanofi, is down by 2.4%. And this is a business that issued some soft guidance, generic competition, a real issue for this company. Euro dollar checking in where we are, 109.27, not an enormous move all told. After that ECB meeting, we heard from one side of the trade, we heard from the Fed, then we heard from the ECB, and we haven't gone all that far. But just checking in on where we are. We saw strong risk aversion and money going into the dollar earlier on, but now we seem to see a little bit more resilience and the euro fighting a little bit of its way back. We've heard from some of the hawks this morning at the ECB out on the wires talking. This is the UK 30-year yield, and I put this in. I could have put the German bond market, I could have put the Italian sovereign debt story, because really we saw these moves across Europe yesterday, and today continues to be a pushback against those. So yields yesterday on this particular 30-year gilt down 19 basis points. So the fact that we're up 5 or so today, keep in mind that we're really just unwinding a little bit of that move we saw yesterday. Again, back to that dovishness from central banks, Matt.
All right, we'll continue to watch what's going on in central banks, especially as it regards the U.S. labor market. We're going to get a jobs report today, likely to show that that market continued to moderate at the start of the year. Still, wage growth, a historically low jobless rate, and high vacancies, I should say, vaccines, are expected to keep the Fed from lowering interest rates for some time. Michael McKee, fully vaccinated, Bloomberg International Economics and Policy correspondent, joins us now. Yeah, 11 million vacancies. It's pretty unbelievable.
It has got Wall Street thinking that we're going to have an upside surprise today. The whisper number 198, which is significantly higher than the 189 that is in the official forecast. But that's the least important number out today. We've got a lot of other numbers in the jobs report that are going to matter more because it's all about telling a story. The story is that the job market is slowing down, so we're expecting a slightly lower rate of job creation. But unemployment has not gone up, and that was a key question for Jay Powell at his news conference. What's the deal? And he seems to think now that maybe it doesn't have to go up as much as the Fed had forecast in December at their last meeting before this week. Average hourly earnings, though, that's the story of the day. 0.3 gain for the month and a 4.3% annual rate. On an annualized basis, we are closer to that green line there. That's the line that the Fed thinks is acceptable in terms of wage increases, is compatible with a 2% inflation rate. So we've still got some ground to cover, but we're getting there. And so Wall Street's going to be watching that to see if we make the kind of progress that they're looking for.
Well, it'll be interesting as well for people just watching the headlines to contrast what could be a strong payrolls report against so many headlines we seem to see each and every day about another company announcing layoffs. I believe there's been more than 100,000 job cut announcements already this year in terms of the number. When do we expect those to actually show up? Because it's not going to actually be in the January report.
No, it's probably not going to be in the January report. We're looking a couple months out. The idea of mass layoff notices, giving people 60 days notice, doesn't always come through, but it probably has a big has a lot to do with why we're not seeing the numbers now. The interesting thing is going to be how do the unemployment numbers affect what the Fed thinks is going on? Because if people have jobs, and as Matt says, if there's that many job openings, then that puts upward pressure on wages in theory. But wage pressures are coming down, and we still have a lot of openings. The Fed thinks, or said in December, that we're going to have 4.6% unemployment this year. We're still at 3.6. So do those two lines converge? That's going to be kind of the question, because if they do, then maybe we don't see wages go up as much.
Mike, thanks very much. Michael McKee with the analysis of the jobs report. And Mike will be bringing you the jobs headlines at 8:30 a.m. Eastern Time. And we'll hear from the Labour Secretary, Marty Walsh, as is traditional, on Jobs Day, 9:30 a.m. in New York, 2:30 p.m. in London. Now, on to tech shares. Another story dominating trading today. Tech shares are sliding after Apple, Amazon and Alphabet all reported downbeat earnings. The results show an economic slowdown is hitting demand for electronics, e-commerce, cloud computing and digital advertising. Apple CEO Tim Cook spoke about the company's sales miss.
As a result of a challenging environment, our revenue was down 5% year over year. We remain confident in and focused on the long-term opportunity.
Let's get to Bloomberg Quick Takes. Alex Webb, who joins us now. And Alex, I mean, focusing in on Apple then there for a start, it had everything really in terms of the headwinds that this business has been facing, from FX concerns to supply chain to end user lack of enthusiasm. What stood out to you?
I think it was the fact that they kept on saying, well, there were supply chain issues, right? That we know that factories in China haven't been able to operate at full capacity. But tagged on the end of that, there's always, and also macroeconomic headwinds, which is ultimately a euphemism for not enough demand. And the question that investors are really asking right now, and why we're seeing some of the doubt creeping, or big doubt clearly creeping into the share price, how much of it is demand, how much of it is supply? Previously, they've had supply chain issues. They've said, we still expect the demand to be there in a few months' time for the next generation of the iPhone, whatever it is. Right now, there's questions over whether that exists and how long it will take to recover.
Yesterday, we saw investors who were happy enough with Facebook making a switch from growth to cost cuts, as long as they're shoveling out cash, right? Buying back $40 billion more shares. Are these any of the AAA companies having to do that to appease investors?
Well, they haven't made similar comments just yet. There was the thing that really stood out with Facebook, as they were emphasizing this change of culture, that this is going to be a year where they're really actually going to focus on costs in a way that they and a lot of the other tech companies haven't really had to do for much of the past decade. We've also seen, though, that Facebook has been trading at a significant discount to all these companies. Back in November, it dipped below a 10 times multiple of forward earnings. It's still at about 16 times forward earnings. Apple's up there at 23, 24. So there was massively low expectations for Facebook. That means that a little bit of good news, a change in the sentiment, the way that the managers are describing their business was therefore taken well by by investors. That has not been the case with Google, Amazon. Google's saying that their capex is going to stay flat this year. Facebook being a little bit more circumspect, saying actually capex is lower than we thought it was, than we had previously telegraphed it's going to be.
Alex, thanks very much. Bloomberg Quick Takes Alex Webb with the latest on the tech names. A real focus for markets, and US Nasdaq futures down by 1.5% this hour. The pressure on Gautam Adani to address concerns over his conglomerate's financial health is still mounting. The brutal stock rout in Adani Group companies has wiped out half of the group's market cap value since the Hindenburg report. Bloomberg's Kriti Gupta joins us now with more. Kriti, where do we start? I mean, just the news flow surrounding this, the sell-off in the shares just continues, despite the fact that Adani continues to push back and say that the allegations made by Hindenburg are false. I mean, just today we heard from a European energy company, Total Energies, talking about its exposure to Adani. You have to wonder where this ends.
Right, and there's so many more places. You had their global sustainability index, for example, really kicking the Adani Group out because of that exposure. The same story, but once again, Anna, the takeaway here is that this is a story of sell first, ask questions later, and that's really where you're seeing about $118 billion of market cap just completely wiped out. And not to mention the short selling even bidding up further. That's really important when you look at some of the options volatility, when you look at what the moves actually are from the share price perspective. But at the end of the day, it's really important to keep in mind that, look, this is a stock that has essentially quadrupled in the last 18 months or so. That is how it kind of came across the Hindenburg report's radar, who claims, by the way, for international audience that hasn't been following the story, that, look, this kind of giant increase is really led by the idea of offshore accounts that are then involved in things like tax fraud, corruption, and of course, a unsanctioned connection to Prime Minister Narendra Modi's infrastructure agenda, something that has really been fueling a lot of the gains in the Adani Enterprises saga.
Of course, Adani refutes those claims. What do we know about what investors want next from Adani? What do politicians want next? What are the next steps?
Yeah, well, so basically they want some sort of confidence, and this is where the debt really comes in handy, because when you look at what the stock market is doing, the stocks have just completely, like I said, wiped out about half of their gains. But the way to kind of enlist a little bit more confidence is to say, look, the debt hasn't sold off by as much as the stock is. So if you prepay those loans, you are then essentially enlisting confidence in the likes of ICICI, which is a major Indian bank, Credit Suisse, other banks that are saying, look, maybe we need to have margin calls. We're not there yet, but that's the fear, and Gautam Adani and his enterprise is getting ahead of it.
All right, Bloomberg's Kriti Gupta following this story. Thank you so much. And be sure to check out today's Big Take, exploring how Adani's crisis is shaking investors' faith in India. Look for that online or on the Bloomberg terminal at NI Big Take Go. Now, though, let's get back to the U.S. markets and take a look at some stocks we are watching in pre-market trading. I have to begin with Nordstrom. 29% move to the upside, and there is one man really to thank for that, Ryan Cohn. Of course, this is a famed meme stock investor. He also, of course, was the co-founder of Chewy. Where he goes, retail investors tend to follow. So news overnight, reportedly, according to Bloomberg, familiar with the matter, that he is now one of the top 5 outside shareholders in this company, pushing potentially to replace a board seat, has this stock flying in pre-market trading. Plenty of stocks are not flying, though, including those that reported earnings yesterday, like Ford. Its profit came up short of expectations. It really shows that this company is struggling to manage the transition from regular combustion engine vehicles to electric vehicles. This stock down about 5% before the bell. And also lower after earnings is Qualcomm, really struggling with the downturn in demand in the smartphone market. So its sales forecast came up short of expectations. As a result, that stock down about 3.4% in early trading, Anna.
Coming up, we're going to talk tech then, Kailey. Adams Fund CEO Mark Stoeckle will join us. His top holdings include the tech trio Apple, Amazon and Alphabet. What does he make of the reports last night? Was he focused on the meta positivity or the negatives around these AAAs? We will also talk to Janet Henry, HSBC Global Chief Economist. We'll take stock of the week that was and look ahead to the jobs report, of course. Plus, we're live in Prague as the Czech president-elect speaks exclusively with Bloomberg about the war in Ukraine.
Ukraine can defeat Russia on Ukrainian soil. It means that to push Russian forces out of Ukraine and restore territorial integrity and full sovereignty of Ukraine. I believe that with our support, this goal is achievable. And we should strive to achieve that goal because it's a matter of principle.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York and Anna Edwards in London. Now, derivatives shops found themselves in a dramatically different era this week, the old days of manually processing deals. It all started with a cyber attack early Tuesday on ION or Ion Trading UK. It's a little known, I don't even know how to pronounce the name, but critically important software company apparently that underpins the smooth functioning of markets. Joining us now to talk about the results of this is Bloomberg Markets editor Lynn Thomason. So it sounds like this is hugely important and a big problem, but maybe the results are just that kids learned how to write tickets. What's happened?
And then probably need to hire some more kids as well if this is going to be a common occurrence. I mean, I think it speaks to the worst nightmare for a lot of trading firms and banks on the street, that something like this could be vulnerable to a cyber attack. And, there's always the potential, especially with a ransomware company, that, sensitive consumer data could be exposed, that trading could be frozen. You just really don't know where to go with it.
And we saw some innovation and also some perhaps panic at some of these businesses then, according to our reporting, Lynn, because for some people this represented the worst of things, going back to the 80s and 90s and manually writing tickets or manually inputting into things that look like early web 1.0 sort of devices to do trades. But for others, groups of coders getting together to quickly try and fill gaps and write new code. I mean, that's quite a fascinating insight into the way that these businesses cope when tech lets them down.
Yeah, absolutely. And maybe that's the new reality that we're in, that, there is this vulnerability of the system, that it is fragile, but, the resilience is that coders are able to come together and try to solve it quickly. But it's still a big unknown, and especially, I think, in this day and age where so much of market structure is interconnected and it's so complicated that, a lot of people would say we don't really understand it until it breaks down.
Lynn, speaking of vulnerabilities, we learned overnight that even the largest of big tech companies are not invulnerable to an economic slowdown. They are subject to those same macroeconomic headwinds. That clearly already weighing on risk sentiment this morning before we even get the payrolls report at 8:30 a.m. Eastern time. How much potential does it have to roil market sentiment even further?
Yeah, I mean, I think it's definitely what people are looking for in the jobs report is this Goldilocks scenario, that inflation's not going to be too hot and we're not going to end up in a recession. And, you're seeing that in the market action this week, that we've had this tremendous rally. Today, there's a bit of a pullback, perhaps another view that things have gotten a little overheated. But, in my mind, the big surprise is how much people have been willing to pile back into tech stocks after, the big sell-off last year.
Lynn, thanks very much. Bloomberg's Lynn Thomason joining us there with the latest on this story and the broader markets. For more market analysis, check out MLIV Go. That's the function to use on your Bloomberg terminal. That's where you find the Markets Live blog. They've been all across all of the tech earnings, the central bank decisions, and they will be looking ahead, of course, to payrolls. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. The Pentagon is tracking a Chinese surveillance balloon that lingered at high altitude over the western U.S. The balloon was spotted over Montana, home to ballistic missile silos. The Pentagon advised against shooting it down because of the risk of falling debris. All this could complicate Secretary of State Antony Blinken's visit to Beijing next week. In the UK, the rail network is being snarled by another mass strike today. 12,000 drivers were set to walk out for the second day this week. Their union warns that more strikes could be announced if talks next week don't lead to a breakthrough. Former Goldman Sachs President Harvey Schwartz is in talks to become the next CEO of private equity firm Carlyle Group. Bloomberg's learned Carlyle board members and shareholders have discussed Schwartz in recent weeks. His arrival at the firm would resolve a long-running succession challenge. And Ford is blaming poor execution and continued supply shortages for fourth quarter profit that missed estimates. The results show the company is struggling to balance the transition to electric cars from conventional vehicles. As a result, Ford will ramp up its cost-saving efforts. Job cuts will be part of that. And we know job cuts also have come for big tech in a big way, Anna.
Yeah, absolutely. Coming up, we'll talk big tech. Mark Stoeckle joins us, Adams Fund's CEO and senior portfolio manager, owner of some of the companies that reported overnight, giving a very different impression of big tech compared to Meta. We'll get into that conversation next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. The latest US jobs report is out a few hours from now. The labour market may be cooling down, but will it be quick enough for the Fed? Tough times for big tech. Apple, Amazon and Alphabet post results that show the economic slowdown is hurting demand for some of their products. And a brutal sell-off gets worse. Gautam Adani's empire has now lost more than half its market value since that report from short seller Hindenburg Research. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, yesterday was all about central banks and about tech. This morning seems to be all about tech. Later, we're going to be all about jobs.
Yeah, absolutely. So we've gone from macro to stock-specific and now we're going to go back to macro. We are down about 0.9% on S&P futures right now. We had a huge rally yesterday, really. The S&P 500 up to, I think, 4170, somewhere around there. So already higher than strategists are forecasting for the year-end levels on average. We are looking at a 10-year that's coming down a little bit. 338.85 is the level on the 10-year, and crude is coming down as well, 75.82 a barrel. So a 75 handle on NYMEX shows the pessimism that we're looking at for this economy. Really, globally, you see commodities prices that haven't rallied after the reopening of China. So I think that's pretty fascinating, especially considering Europe doesn't look as bad as we may have thought in regards to a recession. Bitcoin is coming down from midnight, but still is above 23,000 at 23,379. So we continue to see strength and really a lack of volatility there. Kailey, what do you see in terms of the pre-market movers?
Well, I'm checking on AAA. That's what we're calling it, right after their reports after the bell yesterday. Trillions and trillions of dollars worth of market value, and that's going to be less come the opening bell in about 4 hours' time, because we are seeing Amazon, Alphabet, and Apple all under some pretty significant pressure after their results. For Amazon, there is some weakness in consumer demand, but the bigger concern perhaps is the cloud division after the company said they do expect growth there to slow over the next several quarters. That's concerning because AWS is one of their big drivers of profit. So that stock is down 5.6%. Alphabet down by about 4.25%. That ad business really coming under pressure as the macroeconomic environment weakens. That's a struggle for Apple too. Weak demand for iPhones and Macs means they just had their worst holiday quarter in 4 years. Sales coming in even more than expected. So that stock is down, bringing all together the QQQ, which is the ETF that tracks the NASDAQ 100, down 1.7% before the bell. When you have a lot of weight dragging things lower, Anna, the broader market is going to go with it.
Okay, so QQQ and AAA in focus as we head towards the US Open. This is what we have for European equity markets. More Alphabet, SUPBAP, Stocks Europe 600 down by 0.25%, factoring in the overnight news around tech. That's certainly one of the drivers here. We've also got some resilience, though, in the London market, and that's very much driven by the energy side of things, financials, also the banking sector, not perhaps as badly hit as some others. Tech is a weaker sector today. Infineon is one of those. This is the chip maker based over in Germany, down by 0.9%. Actually, the business itself reported some numbers that could have gone down pretty well with analysts. Their guidance around one of their areas of end consumer, the auto sector, was pretty strong, and so there was an upgrade to some of the guidance they were giving, but they did acknowledge that end consumers in the consumer segment did look a little bit weaker, and so that is weighing, as well as some of the news we had overnight from US big tech. Sanofi is down by 2.8%, the drug maker over in France. That business reporting numbers as well, but generic competition leading to some slightly weaker guidance coming through, and the stock sells off. The UK 30-year yield I put in here, and interesting, we're seeing 6 basis points higher in yields today, but we lost 19 yesterday. We saw some big moves downwards in these yields in Europe. I picked the UK market because that's where the moves were biggest, but also in the German, the Italian debt markets. We saw those yields coming down yesterday, and we see those yields bouncing just a little bit today then, Kailey.
All right, Anna, well, let's get back to the big tech story here in the U.S. Joining us now is Mark Stoeckle, CEO of Adams Funds. Mark's top holdings include the tech trio, AAA, trifecta, whatever we want to call it, Apple, Amazon, and Alphabet. He is up early for us here on the East Coast this morning. So, Mark, thank you very much for that. Prior to these results, we had seen a massive rally in these tech stocks so far in 2023. Now that you've seen the prints, is that deserved? What kind of multiple is appropriate for these companies that are no longer growing like they once were?
Well, I think that's probably the most important question to ask, Kailey, is what do you pay for these? Let's start with all three companies are good companies. There's nothing wrong with their companies, but we try very hard to make a distinction between a great company and a good stock. And we would contend that these stocks are just okay because they are expensive. And one of the things that I think has been a little confounding this year, as you just mentioned, is they've all run into their prints. They're up significantly this year, and frankly, I thought they'd be down a little bit more than they are pre-market. So we'll see what happens with the trading, but each of them in their own right is at varying levels of expensive. And again, good companies, but are they stocks to own in a big way right now? We think you could probably add to them, which we would like to do over time at lower prices here.
Mark, can you contrast these companies with Meta? Because it wasn't very expensive by a lot of the same measures, but it also managed to give back an extra $40 billion or announce another $40 billion in share buybacks. We didn't see any of those kind of announcements from these companies.
Yeah, Matt, it's a good question because the Meta, I would describe Meta as being a rubber band that was stretched really, really hard, and so the snapback shouldn't surprise too much. I think that they were the first one to report, and frankly, it seemed to me that Apple, Amazon, and Alphabet all listened to that call because everybody effectively said the same thing. Operating efficiencies, we're going to be more diligent on expenses and those kinds of things. But I think the Meta was surprising to me in that, effectively they had $125 billion of market cap added to the company, and they really only reduced expenses by about $5 or $6 billion. But I do think that snapback doesn't surprise me that much because it was among, as you just mentioned, among all these stocks, the cheapest by a long shot.
Yeah, they might have delivered similar messages, Mark, good morning to you, to what we'd heard from Meta, but it certainly didn't have the same impact on the share price as you point out. Let me go to the Google story here, or the Alphabet story, and AI. AI got a lot of mention. ChatGPT, you can't move for mentions of ChatGPT across all kinds of media so far in 2023, Mark. How much is this adding to the planning around that theme over at Alphabet?
Well, I think it's adding a lot, but I also think that how would each of us react with a slowing search business? Cloud was fine, but their real engine is search is slowing. So if I'm the CEO, I'm doing exactly what they did, which is I'm going to talk about the next thing, and the next thing for them is AI. I do think that they're approaching this. It appears they're approaching this in a very thoughtful way. They want to be careful about how they enable it, how they roll it out. But I'm not really surprised that they're trying to pivot. And the number of times in the call that the CEO talked about AI was borderline annoying. But I would do the same thing if my big engine, the search business, was slowing.
Well, and Mark, of course, Alphabet is one of the long list of tech companies that have announced job cuts this year. Bank of America put out some research earlier this week that essentially said we've seen 80% growth in employee count for tech companies over the last 3 years, but only a 60% sales growth number over that period. They view that as a 20% overshoot, even if there is no more demand hit from there, which clearly borne out in these three results. We are seeing demand slowing down. How much more trimming of the fat do these companies need to do?
I think they need to do a lot, and I haven't seen the Bank of America piece that you referenced, but I will tell you one of the things that I think is a challenge for all four companies, the AAA as you called it, and Meta, is the fact that they did get fat, that, you know, a lot of hiring. It's not in their culture. I mean, these companies haven't come to greatness by worrying about expenses. In many respects, they've had the luxury of having revenue growth really carry all their expense growth, cover all their expense growth. That has changed, and I think that pivot is really hard for these companies. And again, we've seen you know, sort of a little tip of the cap to reducing expenses, but I think directionally, Bank of America is right that there is a lot more they could do, and frankly, a lot more they should have done and should have done faster. To be fair, the reduction in force that Amazon mentioned, the 18,000 people, that's a pretty big number, and I think that they probably did the best job of expense reduction, or at least talking about it. But you know, Alphabet and Apple, I think, really need to do a better job of taking out expenses at a faster rate, even though from a cultural standpoint, that pivot is very difficult for them.
Yeah, Mark, thank you very much. We appreciate your time. Mark Stoeckle of Adams Funds, thank you very much for joining us to talk about some of the businesses that he holds. Coming up, we'll get back to the macro conversation. Janet Henry will be with us, HSBC Global Chief Economist, and it is a global view you need this week, from the Fed to the ECB to the jobs report out of the US. We'll get her perspective. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Council of Economic Advisors member Heather Boucher. That's at 12 p.m. New York time, 5 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York and Anna Edwards in London. Now, U.S. jobs data may show a slowdown in hiring. Estimates say the economy added 189,000 jobs in January. Still, wages are expected to keep rising, and the jobless rate is near a 5-decade low. Joining us now is Janet Henry, Global Chief Economist at HSBC. Janet, what do you think about this labor market? I mean, depending on what metric you look at, it can appear incredibly tight or maybe loosening a little.
It can be argued as loosening a little, and certainly we are hearing headlines about job layoffs and such like. But we've also had a report from the ADP about January. So I think we know that there might be a weather-related effect. The ADP survey-related release suggested a marked slowdown, but you had floods on the west and snow on the east coast. Whereas actually, if you look at the hiring data, still strong. And certainly we think there might be an upside risk to today's release. But as you mentioned, it's the wages number that probably will be most important rather than the job creation.
Okay, and thinking about what links that with inflation then, Janet, I mean, do you think, is it possible to have a situation where inflation does come down back to target, but the jobs market doesn't really move all that much and doesn't crack all that much? Is that something that is possible, or is it one of those, it's simply you can't have that sort of Goldilocks situation?
Well, you've never had it before, is the truth of the matter. But over the last couple of months, the labour market has been fairly firm, and we have seen wage growth moderate. And I think that's what the markets certainly at the moment are hoping for. And to some degree, that is what's built into the Fed's forecasts, that we're going to see only a very tiny rise in unemployment in the coming year, but wage growth will slow and inflation will be able to slow back. But it would be exceptionally unusual. And I think what's been interesting over the last couple of months is that even construction has still been adding jobs. Now, we've been in a residential construction recession for a year, but construction's still adding jobs. Manufacturing is still adding jobs. So we've seen it in the UK that the economy can be almost flatlining, but the labour market still remain quite firm. Maybe it's labour hoarding to some degree, at first signs of slowdown. So I think that the risks in the US is that the labour market does stay a bit stronger, and that we don't necessarily see wage growth continue on a downward track without seeing some rise in unemployment, which obviously will hinge on how much the Fed continues to raise interest rates.
Right. And Janet, to that point, in theory, a strong labor market would raise the odds of a soft landing for the U.S. economy. But I also could see the case that it raises the odds of a hard landing, because if it remains too strong, the Fed needs to go that much harder. Even the terminal rate, if they hang out there for a while on pause, realize wage growth is still fueling inflation, they may need to hike again. How do you think about those two scenarios?
Well, as you say, a strong labour market, it hinges on whether it's job creation or it's actually wage growth. The Fed would obviously love it if we were to see wage growth to return to something that's more consistent with getting back to a 2% inflation target. If we can get, with 3.5% unemployment, wage growth slowing to 3% or below, then maybe they will be confident that we are in this true Goldilocks world. So I think if they're going to focus on one thing in particular, it will be the wage numbers. So today, we're pretty much in line with the market and expecting another monthly increase of 0.3. That would take annual wage growth down to about 4.3. They need to see it continuing to fall on a downward track and not give any suggestion that they are going to change course rapidly. And obviously that's what the market's pricing in, that they will finish raising rates in March, but then have a quick reversal. And I think the message that the Fed's been trying to tell us is that, yes, that might be enough to stop then, but don't look for a quick reversal. They are worried about inflation becoming entrenched, not at 6 or 8%, but maybe at 3 or 4% when their target is 2, and therefore having to keep policy tighter for significantly longer. And I think that's a message we've heard from some other central banks in the last couple of days as well.
Janet, I wonder what you think when you look at the JOLTS numbers or the job openings of 11 million at the same time as we're, every day reporting news stories of layoffs in the thousands or tens of thousands. Why do you think that number, the openings number, is so high? Is it real?
Well, there's always some concern. You get kind of jobs that have just been advertising for some time and don't get taken down. But hiring was strong as well in those jobs numbers. It was job openings as well as job hirings still remaining quite strong. And I think the difficulty with some of these headline numbers of job losses, a lot of them are made by very, very large companies, many of which did not fire anyone during the worst of the recession. In fact, they still hired quite aggressively. And now there's a degree of catch up. And we need to remember that most people don't work for these larger companies. A lot of them work for very, very small companies indeed. And I mentioned the construction sector. For a time, you couldn't get a builder for about a 2-year waiting list. Whereas actually, if you are managing to get more builders, maybe those waiting lists for some of the smaller jobs, even if other broader big areas of housing are starting to slow down, you've still got that demand coming through. So I think what's happening at the establishment level by firm size is quite important to what's happening in these labour markets as well.
Janet, thank you very much. Janet Henry of HSBC looking ahead to the jobs report. Later today, we will get the White House view on that US jobs report. Labour Secretary Marty Walsh will join us 9:30 a.m. in New York, 2:30 p.m. if you're here in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York. Anna Edwards is in London. We are almost through with a very long week, but first we have to get through this Friday. The big event of the day, as we've been saying, is the U.S. jobs report. That comes at 8:30 a.m. Eastern time. There's also closing arguments in the Elon Musk fraud trial set for today, followed by jury deliberations. And finally, Ukraine and the European Commission are holding a summit to discuss Kyiv's integration in the bloc, with Ursula von der Leyen and Charles Michel expected to attend. Anna.
Now, speaking of what is happening with Ukraine, the Czech president-elect has been speaking with Bloomberg's Maria Tadeo in Prague about the ongoing war. Maria joins us now for more on that exclusive conversation. Maria, what did he tell you?
Yes, Anna, and we spoke with General Pavel, and I say general because he was a former top-ranking NATO general before becoming a politician and president-elect in the Czech Republic. Remember, there was an election on Sunday, and I talked to him about, obviously, the war in Ukraine and bringing together the politics and his military experience in real combat. I asked him, is it realistic? Is it possible that Ukraine can defeat and achieve a victory over Russia? This is what he had to tell me. Let's take a look.
We see in Russia pushing the situation up to the edge quite often, provoking fears in Western democratic countries that should prevent them from continuation of support to Ukraine. I believe that we shouldn't get too scared by Russian escalation. We should stay firm and keep pushing on Russia to respect the norms of international law.
And that was General Pavel speaking, just a few minutes ago here from Prague to Bloomberg TV. And beyond that, of course, I also asked him, well, if you look at what is happening today in Ukraine with von der Leyen and all of the European representatives there meeting with President Zelensky, what about Ukraine joining NATO? What about Ukraine joining the EU? And he told me it's a yes, in his view, of course, to both questions. He said at this point, NATO, should be an option for Ukraine. They are NATO compatible in his view. Of course, there's a lot of debate as to whether this will happen hypothetically one day. But when it comes to the European Union, he was even more explicit and told me there's no way you can talk about reconstruction of Ukraine without talking about membership in the future.
Very interesting. He also had some pretty hawkish comments on China. I mean, you don't even have any surveillance balloons floating above you that I can see. Pretty unusual for maybe a small country to make those kind of remarks.
Yeah, absolutely. And you always usually want to play it diplomatically, right, with a country like China in general terms. But it is interesting that as soon as he was elected, he got on the phone with President Zelensky, but he also took a phone call from the leader of Taiwan that immediately provoked a reaction from China, saying that this was a provocation and they viewed this as provocative behavior from the Czech Republic. He told me China does not have a right to tell another sovereign country what to do, who they can get on the phone with, and what they can say. I also asked him, in your view, is China a friend in general to the West? He said it's not. There's some areas where maybe there's cooperation, but they're not friendly. And that's something to keep in mind potentially going into the future and drawing also lessons from the war in Ukraine.
Okay, Maria, thank you very much. Interesting to get Maria Tadeo and the highlights from that interview that she just had with the president-elect over there in Prague. Interesting to get that perspective from one Eastern European country, at least. That is it for Early Edition. Surveillance is up ahead. They'll be hearing from Glenn Hubbard, Columbia University professor and former chairman of the Council of Economic Advisors. Great voice to have on the day you get the jobs report and in Fed Week. This is Bloomberg.